Have you ever looked at a giant company and just wondered, what is it actually worth? It's a huge question, one that can make or break fortunes and keeps executives up at night. I mean, think about it. How do you take a massive global operation with all its employees, its patents, its brand, its ambitions, and somehow distill all of that down into a single number? What is its real, true value? Well, it might look like some kind of financial wizardry from the outside, but it's not magic. According to valuation expert Aswath Damodaran, any good valuation really comes down to a surprisingly simple framework. It's all built on just three fundamental pillars. All right, so pillar number one is what we call the cash engine. And honestly, it's the most intuitive one. At its very core, a business is simply worth the amount of cash it can produce for its investors over its entire life. That's it. The best way to think about this is like owning a rental property. What makes that property valuable? It's not the fresh coat of paint or the new landscaping. It's the rent you collect, minus the mortgage, the taxes, and all the repair costs. It's the cash that ends up in your pocket. It's the exact same for a company. We're not talking about revenue here. We're talking about the cold, hard cash that's left over after everything's been paid for. Now, in the finance world, they have a name for this: free cash flow to the firm. It's the total cash the business generates for everybody who has a stake in it. That means both stockholders and the people who loan the company money. This number right here is the true horsepower of the company's cash engine. Okay, but a company's value isn't just about the cash it's making right now. The market is always looking to the future. And that brings us right to our second pillar, the growth accelerator. So, how does a company grow in a way that actually creates value? Well, it really boils down to a two-step process. First, the company has to reinvest some of its cash back into itself, to build new factories, fund new research, or buy other companies. But, and this part is absolutely crucial, it's not enough to just spend money. The company has to earn a higher return on that investment than what it cost to get the money in the first place. If it doesn't, it can actually destroy value even while it's growing. And this is where you start to see two completely different kinds of companies. On one side, you have the young, high-growth firm. It's probably pouring almost every dollar it makes back into the business, chasing these huge potential returns in brand new markets. Then you've got your mature, stable company. It's reinvesting less and is more likely to just pay out that cash to its investors. Neither approach is inherently better. They're just different strategies for different stages in a company's life. So we have the cash engine and the growth accelerator. But both of those are based on promises about the future. And as we all know, the future is uncertain. This brings us to the final pillar, the one that anchors everything in reality, the risk anchor. The way we factor in risk is with something called a discount rate. You can think of it as the price of uncertainty. If a company's future cash flows feel like a risky bet, investors are going to demand a higher potential payday for taking that gamble. So, higher risk means a higher discount rate, which in turn means those future dollars are worth a lot less today. But listen, not all risk is created equal. There's a really key distinction here. You've got firm-specific risk, like what if a new product totally flops? For a smart, diversified investor, that's not a huge deal, because their other investments will probably balance it out. The risk that truly matters, the one that really drives that discount rate, is market risk. We're talking about recessions, changes in interest rates, things that hit pretty much all companies. That's the one you can't escape. Okay, so cash, growth, and risk. We've got our three pillars. So how do analysts on Wall Street actually put this all together? Well, they basically use two different lenses to look at the very same company. On one side, you have what's called intrinsic value. And the main tool here is a discounted cash flow, or DCF analysis. This is the deep dive approach, where you try to forecast all the future cash, apply your assumptions about growth and risk, and land on what you think the company is fundamentally worth. On the other side, you've got relative value. This is way simpler. You're basically just looking at what other people are paying for similar companies, using these quick and dirty metrics called multiples. Let's look at a perfect example of this using a super common multiple, the price to earnings, or PE ratio. So here in the beverage sector, you can see that Andres Wines is trading at a PE ratio that's much, much lower than the industry average. So you look at that and you immediately think, okay, that's the one. It's the cheapest. It's a bargain, right? Well, not so fast. And this is exactly why you have to bring it back to our three pillars. A low PE isn't an automatic buy signal. The market, the collection of all investors, might be pricing it that low because it expects weaker growth, or maybe it sees more risk ahead for that company. You see, the multiple is just a number. The three pillars tell you the story behind that number. And that brings us to a final and I think really critical idea. Because after you've built all the spreadsheets and run all the formulas, you still have to deal with the most unpredictable variable of all, the human factor. There's this great quote from Damodaran that says, "A valuation cannot be judged by its precision." You can build the most complex, detailed financial model in the world down to the fourth decimal place, but at the end of the day, it's still just a collection of educated guesses about a very uncertain future. And because it relies on human judgment, it is incredibly vulnerable to bias. It happens all the time. An analyst already has a price they want to hit, so they just tweak the growth and risk numbers until the model spits out what they want. Or they'll try to justify paying a crazy price for an acquisition by just throwing around this fuzzy, magical word, synergy. It's a craft and an art, not just a pure science. So I want to leave you with this. Every valuation, every price target, every buy or sell rating, it tells a story. It's a story about that company's future cash, its potential for growth, and the risks it faces along the way. So the next time you hear someone talk about a company's value, ask yourself, are you just hearing a number, or do you actually understand the story behind it? Because that is the difference between simply guessing and truly understanding.